All right, everybody, welcome to this week's Middle Class Investor. This is Seth Martin. It is Monday, May 29th, Memorial Day. Happy Memorial Day to everybody. And thank you for those of you that have families that have lost soldiers in conflict overseas. That's what Memorial Day is for, is to remember those, the fallen soldiers, and the people that have given, paid the ultimate price for their country. So, all right, moving right along. This is the bull market since the March 9th low, and I think it's important to note that this is an Elliott wave principle. But once you have 5 waves, which we have here, this is very well defined. This is a typical 5-wave impulsive pattern. Once you have that, then typically what happens, unless wave 5 extends, which it could, but it's not likely given that it looks a lot like wave 1. So once you have this 5-wave pattern, it typically reverts back to the 4th wave low at a minimum. So what you can expect here over the next coming months is a move back to around 1800 on the S&P 500. And I don't know the wave low on the Dow, but certainly there's a wave 4 low that we could look at it real quick. I don't have it drawn, but we can probably identify it. Yeah, probably around here, around just below 15,000 on the Dow. So again, the purpose of this weekly program is to try to help you preserve you and your money, your capital, your investment capital, your retirement capital. And part of that is determining where we are in the trend. Okay, so all along in here, there's no risk really in being in long-term investments and having a balanced portfolio and all that mess. But when you start getting to the end of a wave 5, risk starts to pick up, and you need to be aware of that. All right, so again, what we're looking at is a move. Let me just show it here real quick. Once this is finished, and of course to be finished, I'm showing a small 4 here and then another 5. So we've got some more time here. I mean, this is gonna play out over the summer, probably toward the end of the summer, maybe even it might take until August or something for this to finish, and then to start moving back in this direction like this. So this is a monthly chart. So let's zoom in slightly and go to a weekly chart. That's normally what we look at as a weekly chart, just because a weekly trend is probably about right for your typical middle class investor. That is somebody that's investing in a 401k or index funds, things like that. So what we're anticipating happening, probably start happening this week, is a pullback into this area, and then another 5-wave move up over the next couple of months into this area. Might not even be that long. Might just be, this whole thing might be 2 months. Shouldn't be much longer. The timing is always difficult to measure on these, because you don't know if this is going to be more complicated. Like this whole pullback was not a simple pullback; it was more complicated. And so, there's a possibility that it could have been finished there, but it's not likely given the proportionality between the wave 1 and the wave 4. So the more likely scenario is that we pull back into here and then we pull forward. But you can see I've kind of got this happening I would say July to August, somewhere in here, we're going to be wrapping this up. And the bull market that's lasted not only since 2009, and then this might be a good time to talk about potentially the much larger picture. And it's hard to see on this chart. Let me see if I can do it log scale. Yeah, log scale is a little bit better. this is out there. Okay, this is potentially a risk, but this this whole trend could have originated back here in 1930, whatever this is, 1933 or whatever. So you had the 1929 crash, ended here in 1932, ran up, pulled back. This is likely the first wave one, and there's a small wave one in here for the remaining of the trend. But if this is 1, 2, and this is all 3, and this is 4, and this is 5, then you can see here that the larger wave 4 pullback is going to be here to below 700, and potentially could be deeper. I mean, that could end up being just wave A of the pullback. Remember, it's the pullback. This trend. This is a what they call an elite wave jargon. It's the right word. This is a super cycle degree trend. So that means there's going to be a super cycle wave pullback. Now that doesn't mean there's not going to be bull markets in between, but that means once the high is in, whatever it ends up being, we won't probably make a new high for a long time. Now there's a caveat to this. If the government destroys the value of the money and this kind of thing, then we'll have to start looking at this pattern relative to gold or relative to some sort of constant like gold. Gold is constant because it's priced in dollars and it can't be just produced out of thin air. So we can put that in the denominator and we'll get a similar chart, but it'll look a little bit differently because gold trades its own. It has its own market that it trades. So anyway, hopefully I haven't confused you on that, but let's go back to a five-year weekly chart. So suffice to say, the risk is going to pick up to at least 1800, and there could be much more to follow. We'll be able to know once we get to this level of support. Does it break through this level of support? I think it's going to break through this level of support anyway, but the question is, does it do it without a significant rally? So if it rallies down here and then bounces significantly and then falls again, then this support level is probably going to be pretty good, maybe slightly lower. But if it just blows right through this level, then we got to go to the next level of support, which was the March 2009 low. So these are going to be big moves, big volatility. A big bear market where they come get everything. So if your broker's telling you, oh, we can be in bonds, that'll be safe, or we can be in this, that'll be safe, the reality is none of it's going to be safe. So that doesn't mean you have to be completely in cash, although cash is a position that people do take. So that'll be for everybody here to decide. I've given you some alternatives like the FXB, some currencies. The FXB to me, more specifically because of the way the currency looks, the British pound, US dollar, if I can find it, there it is right there. If you look at this on a very large, say a 20-year basis, this to me looks like an ABC. So initially we had it stopping here if this was a wave 2, but it broke through that. And to me, this looks like a very large A, B, C. So we're just now starting to move out here. So to me, the FXB is a great place to be, and unless this turns around and makes a lower low. But if it does, we know where we're wrong, right? We're wrong right below here. So what we're looking for here in the British pound US dollar, sorry about that, I'm just clicking on things, is a pullback into this area here. And then this would be a great place to go long and start earning some investment dollars going this way on the British pound. So we can use the FXB as a proxy for the British pound, certainly viable. And you can see that on a pretty large scale basis, this has been going down for a while. It's made a low, it's made higher lows. we would expect this trend line to hold. So keep an eye on the FXB. I think that looks like a really good place to put some or a lot of your money. Of course, we're keeping an eye on gold and silver and things like that as well. But let's first look at yields. The 10-year, you know, we've talked about it pulled into this box. We've talked about it pulling back there, which it has. It seems like to me it's got some more to go. We talked about it coming to the closing this gap, or even coming to the midpoint of this large white candle right here, which usually ends up being kind of the middle of the trend. So we get like a 50% retracement. It's even possible that we get a pullback all the way to here. But suffice it to say, I don't think the pullback is finished. I think we're likely to get at least the close of the gap, and I would say maybe a 60-70% chance that we pull back to here, and maybe a slightly smaller chance, maybe only a 30 or 40% chance that we pull back to here. So hopefully that helps you guys. Certainly, you know, we wouldn't even want to enter. We wouldn't even want to be long yields, and I'll talk about how to get long yields here in a minute. We wouldn't want to be long yields unless we at least close the gap. And then so what we'll do is we'll start looking for a trade setup once we get to the gap close. And then look to be long yields. Let's look at the very short-term yields. There's been a lot of talk about the Fed raising rates. The Fed is not going to raise rates because this chart is going up and still going up rapidly. The Fed cannot, they can, but it's going to be disastrous if they do go against this chart. If they try to do something other than what the market is telegraphing, it'll be disastrous for the financial market. So expect the Fed to raise rates here in June at their next meeting or at their next announcement. I guess they've already had the meeting, and they'll be making the announcement. Okay, to be long the 10-year, if you wanted to be long yields, you could look at something called the TBT. It's an ETF. It trades. It's the short bond market, so it's the short 20-year treasury. And you can see here it's pulling back, and we've got this box here, this decision point area that we've got on the chart here. So this is the TBT. So again, we're looking for this to pull back farther. This probably right here closes the gap, and then maybe a little lower down here would really somewhere. I don't know if I would expect this to get much lower than this right here. This looks like the previous wave 4. Actually, this one right here is probably the previous wave 4 low. So I don't know that I would expect it to get much lower than this before it takes off. If it gets lower than this, then we're probably wrong and we need to reevaluate the chart. But certainly when this takes off, there's going to be some money to be made in the TBT. So it's another place to be when the market, you know, starts really selling off and you're not making any money. Volatility is low still. It's, you know, it's very, very low. It's almost at new lows. I wouldn't expect volatility I would expect volatility to remain low until we break out of this downtrend line. Now you can see it's not going to be long, right? I mean, it can't go on like this forever, because at some point when you get to this where the market really pinches, it tends to break either one way or the other. And I would say, given how low it is, the odds are it's going to break this way. So now it doesn't have to wait till October to do that. It can do that in July or August or somewhere in here. But suffice it to say, this range is getting narrower and narrower. Think of this like a spring. The market is winding up like a spring, and once there's enough pressure in the spring, it pops, and that's what you're seeing right here in the volatility. Now the volatility, even though we've got a trend line here, it doesn't really trade like a stock, so you can't. I mean, there may be excursions out here. It may pop up and then tuck right back in, or it may move around a lot. But once it breaks out in a significant way and starts printing, data points like these right here above this line, then I think volatility is going to probably go out and not return for a long time. So, and that just means there's more risk in the market. There's going to be basically for retail traders and people that aren't very experienced. When the volatility is high, it's harder to make money. Now, for guys that are really good in the market, it's actually easier for them to make money because the intraday moves are bigger and they can make more in a day, every day, than normal. I mean, if you just go look at, I'll give you an example. If you look at the S&P 500, let's see, there's what's it called? Study. Let's look for something called average true range. And I'll show you what I'm talking about. Average true range. Here it is. So let's put that on there and hit OK. So when this average true range, in other words, the daily range of the market, when it starts to expand, your professional traders actually can make a lot of money. When it gets really low like this, it makes more sense to be indexed to the general market. But as you can see, when there's a lot more volatility and there's a lot more swings in the market, it's usually associated with some sort of large degree down move, and which is what we're expecting. If you based on what we talked about at the very beginning of the program, we talked about this being a wave 5, and we're gonna return down here to the wave 4 low, or go through it, but at least go down here to the wave 4 low. So anyway, let's take the average true range off. But that's what I mean by the volatility. When the volatility expands, the daily bars get bigger. These daily bars, you can see these big black ones in here. They get bigger. Here, let me zoom in a little bit. You can see here, this bar here, for example, is big long bar, big long bar. When these bars get longer, the professionals really have a lot easier time of making money, because they literally sell the open and buy the close and so on and so forth, and then they can make a lot more money intraday. These are intra-week, actually. These bars are intra-week, but you'd have the same thing on a daily chart as well. All right, let's take the average true range off. Let's take do all that mess, okay? And then let's start looking at some of these countries. We got Germany. As you recall, hopefully you recall, some of you, we've had this box up here forever, and I think you're going to see Germany continue to make its way up to this box. All this is a box that we put above the market, above the most recent pivot high. That's what you're seeing there. So here's the most recent pivot high. This box is just arbitrarily drawn there. Okay, it's just typical. The market tends to go slightly past the old pivot. Okay, just like here, there's a pivot right here. Let me draw this. Let me try to illustrate here what I'm talking about. See, we've talked about this before, but here's a pivot, and the market goes down, and you can see here this high went just beyond this pivot, which made a new pivot. And so if you're trading, you'd want to set your target. Like, for example, let's say you were buying right here. You'd want to set your target just above that pivot high. So this would be your target. And you can see it pull back a little bit when it hit that pivot and then kept going. So this is the way the market trades at every degree of trend. It doesn't matter if it's a long-term chart or a shorter-term chart. It's like this throughout. And that's because the market is fractaled in nature. Okay, this is Japan. Japan's already at its box. So again, this box is just arbitrarily drawn off this pivot high that I've got marked in yellow. And Japan could go a little higher, or it might start to trade sideways in here and start to roll over. The United Kingdom, it's a lot further from its pivot high. Its pivot high is right here. And this is all inside of a channel, which usually is corrective in nature, which means the direction of the trend is already potentially in this direction, downward. And this is just a momentary pause in the trend. Now, one of the things we could look at for the UK is we could look at Fibonacci and just see how much of the trend it's retraced, because that's helpful to know. And you can see it's already retraced 62% of the trend. So that's pretty typical. 2/3 of the trend gets retraced in the direction of the trend. So we had a move down. We've retraced 2/3 of it. And this is probably a good place for the United Kingdom to turn. But, you know, there's political things going on with the United Kingdom. So it's, you know, who knows? It's still a good place to go short, but you would want to have a stop just above these highs here if you wanted to short the UK market. All right, let's switch over to the other charts and look at gold and some of the currencies and stuff. Let's look at the euro US dollar first. So, you know, I had this box drawn on here, and it did touch the box, but I didn't think it really went far enough. But now it's starting to look like the euro is more bullish. This downtrend line has been broken, but not convincingly yet. I mean, I could extend this a little bit, and then you can see the downtrend line technically has not been broken. But I don't know, the euro looks pretty bullish here. So this could just be the first move off the bottom. We get a little pullback and then boom, rally. So we'll watch the euro closely. I thought the dollar had a new high in it, but maybe it doesn't. It might be done for now. So, you know, we'll watch it closely. The British pound we've already talked about. You know, this is a big old giant ABC pattern. It's a great place to get long after we get some sort of pullback. And the gold, we've talked about the long-term trend in gold and what to expect in gold, but gold appears to continue to be bullish right now. We've got this decision point area located up here on the chart, right up here. I'm looking at this particular one right here. So even though gold might pull back even to here, because this could be an ABC, it could pull back to just below here and then bounce from here. But either way, gold is probably headed here before it goes lower. So you could enter gold here, or you could wait and see if it pulls back to here first. If you're going to trade gold, or you're going to invest in gold, just in paper, just use the GLD. That's the proxy for the ETF proxy for gold. So if we go back over here and we type in GLD, let me do that real quick. GLD. This would be the instrument you would use to trade gold, and you can see it trades at 100. So if you divide this by 10 or multiply it by 10, that's the price of gold. Now these funds, you don't really want to hold these funds for long term, because the expense ratios, they have to do all kinds of futures trading and things like that to get this market to track the gold market, and there's expenses associated with that. There's costs associated with that, and those costs get reflected in this fund. So if you hold this fund for a long time, what you'll see is the value of your money just diminish, even though, let's say, gold's going sideways. You know, that's kind of how some of these funds work. GLD's expenses are fairly low. There's some other funds that, and I'll tell you about the ones that have real high expenses, but there's some other ones that whose expenses are not are much higher than GLD. So let's go back over to the TOS charts and look at silver. I closed the wrong thing down. There we go. Silver looks a lot like gold, and again, silver's kind of already pulled back to this decision point area, so it maybe even looks more bullish than gold. Looks like gold might have another pullback in it, and silver doesn't, or maybe it does. I mean, it's hard to tell. I mean, these commodity markets, the way they trade is so bumpy and choppy. I'm sure there's a lot of opportunity in here intraday, but it could pull back to just below this low here, and then resume the uptrend to here. And I've even got that red line on it there. So we're looking for silver somewhere between 2175 and 26. Pull back somewhere in there. So certainly by the time you get to this old high, you need to be watching silver closely. So let's talk about that for a sec. Let's say you trade it to the old high and you get a candle like that. Well, then you're still in, right? But then you get a candle like that, you're still in. But then you get one like this, and maybe it has a long tail on it. Like this tail thing happens all the time at tops, and you might even get one that looks like a doji. So a doji is one that has a tail on the top and the bottom. Well, then what you want to do is you'll want to put a stop below here, below these two candles. And if you get a break like that, if you get a break of that line, then you want to get out, because that tells you the trend is starting to change. Really, these dojis are kind of a signal of the trend starting to change. If you kind of look at this area right in here, it's very similar to this area right in here. Let's zoom in on that. That'll give you a better idea. So zoom in right here, and you can see it ran up and pulled back, and you get this doji, and then it closed below, and then you get another rally, and you get these long tails. When you get these long tails, what you want to do is just kind of arbitrarily pick a place below there and say that, like in this case, maybe on this day right here, I'm out, because it broke below that candle. Now, or you might have been out this day because it opened below this line, ran up. Of course, you've been kicking yourself like, oh man, I shouldn't have got out. But that's kind of the way the market is. I mean, it doesn't just decide. It decides over some tug of war. This is all tug of war happening, and then finally it breaks, retests, and then falls. So you usually have a little bit of time to play with when you don't have to get out precisely unless you're trying to get out like up in here. You don't have to get out precisely at certain points. You usually get a retest. And if it does fall quickly like this one right here, there wasn't a lot of doji activity here, it just fell, then 9 times out of 10 it's going to rally again, and you can get back out at another place. So really what you want to see is this kind of activity. This is telling you something about the intermediate term trend. This may be telling you, if I zoomed in on a daily chart or an hourly chart, it may be telling me, that the trend is over for that time frame. But for an intermediate basis, this does not mean the trend is over. You can see here it fell pretty quickly, and then bounced, and then kept going. So it takes a while to get used to looking at some of these patterns, but once you start to see them, they just appear over and over and over again. It becomes a lot simpler. All right, we looked at gold, we looked at silver. We can look at the market. We've already looked at the market, but we can look at the market here. You can see I've got it labeled. You can see 3, 4, and 5 here. We're in 5. And 5's not complete, presumably. Now I've got a triangle drawn on here, but it's looking less and less like a triangle as possible, mainly because it broke out of the triangle. So I'm going to go ahead and take those off. And I think more likely what we have now is we've got, let me try this again. Zoom in on it in a way that I can share with you guys. You can see here it's more likely that this is the case, and that a straight line, that we're going to have some sort of retest of this line here before we bounce and take off to new highs. And new highs, I mean, this channel should hold. Sometimes you get a little intraday action of exceeding the channel. So let's look at there's the channel. So, I mean, the market could go all the way up to the top of this channel. It's not likely. I don't think there's enough. Wave 5 would have to extend even further, and I don't think that's likely given the way, just the shape. There's symmetry in this particular run up from March low. And I think if the market extended further to like 2,800, we would lose some of that symmetry. So I don't think that's likely to happen. It could happen. What you do if you're in the market and you want to stay in the market is just set yourself a stop. Somewhere around here, around I would say if we broke, after it pulls back and then starts to rally again, just put a low under these lows here around 23.40. If it breaks 23.40, this pattern is done for. So I think that's probably the best way to look at it. Of course, everybody has your own techniques, your own standards. Just trying to help those here that don't, probably put a little system behind it. All right, everybody, I guess that is it for this week. I really, we're getting closer and closer. Certainly next week and the week after, we're going to have some sort of downturn as we start to experience this wave C in the S&P 500 that we've talked about. So, we'll probably see some sort of, over the next couple of weeks, see some sort of C wave, pretty aggressive selling down to this area. And then just as quickly as it came down here, turn around and start rallying. So, but I would say by August, this whole thing's going to be over. So come the 4th of July weekend, we need to really be looking carefully at where we are in this trend and not get too greedy and start tightening up stops and things like that. All right, everybody, thanks for coming in this week. It's Middle Class Investor. You can always follow me on Twitter at InvestorClass, or just leave comments here on the YouTube channel. And if you leave a comment, I'll be happy to respond. Thanks a lot, everybody. Have a great Memorial Day weekend. Bye-bye.